In this class we want to talk about exchange rates and look at some of the factors that influence exchange rates and broad patterns of how countries have come to deal with exchange rates over the years. For a start, when we have a long-term deficit on the balance of payments, that leads to a decline in the value of the currency. Quite simply, if a country is importing more than it's exporting, then the country must pay for the net difference, must pay for the excess imports, and it does that by selling its own currency, which forces down the value of its currency on the foreign exchange market, so the exchange rate will fall. So if a country is running a long-term deficit, its exchange rate will tend to fall. However, nowadays exchange rates are also determined to quite a significant degree by movements of capital around the world. This is sometimes referred to as hot money. Hot money means brokers and fund managers and large companies, they have excess funds. These funds, they're looking for the highest rate of return, so they will move them to countries that has the highest rate of return, but they have no problems about moving it on to a different country should the incentive arise in someplace else. So we have this money bouncing around the world into different financial centres and out. So exchange rates tend to move because of these factors, as well as imports and exports. But this sort of so-called hot money is one of the reasons why we get movements on the exchange rates, and sometimes it can become quite problematic when we think there is a so-called run on the exchange rate. The exchange rate is the price at which a currency is exchanged for another currency, and this happens through the foreign exchange market. There is no centre to the foreign exchange market. It operates in just about every city in the world. It's a system where it's a market where buying and selling of currencies happen. Banks do it all the time. And the value of the exchange rate, of course, is determined by our desire to have a different currency, be that to pay for a holiday or to pay for imports or whatever. So the exchange rate tends to be determined by us. Now, the government can respond to this by having a freely floating exchange rate or a fixed one. If we have a fixed exchange rate, that would encourage international trade, because let's say an importer wants to import something, to place the order for it, it might be 6 months before it arrives in the country, by which time the exchange rate might have moved. So it was profitable at the start, but now the exchange rate has moved, it may not be profitable when it finally arrives in the country. So to get over this problem of exchange rate moving, the government might try to fix the exchange rate. So there's been a lot of emphasis in the history of trade between countries trying to fix their exchange rate and thereby encourage trade between the two centres. There are many problems with this policy, as we'll see later. The alternative to fixing the exchange rate is just to allow it to float up and down. So if a country is importing a lot, then the value of its currency will start to fall. Well, if it's freely floating, it'll just fall and fall. And as it falls, imports become more expensive, and there should be less imports. So it should correct itself. Generally speaking, when we trade in US dollars. The US dollar is like the international currency. That is the currency that everyone trusts. So smaller currencies are not used. There's not enough gold in the system to finance world trade, so we only have the US dollar. And the Americans keep a stock of dollars outside of America for the purpose of financing world trade. They don't force us into using it. We use it naturally because we trust the American dollar, and that's the way it works. Of course, when we trade, there are transaction costs. So there is a transaction effect. And also, of course, as we trade in currencies, currencies would, say, for example, rise in value, then the demand for the currency would fall. If the currency rises in value, then we want less of it. So a currency that's rising in value means that imports are becoming cheaper. Exports are becoming expensive. If a currency falls in value, then imports are becoming more expensive, so we'd have less imports. If a currency is rising in value, imports become if the currency is rising in value, then the imports are becoming cheaper, so we'd have a growth of imports. So we can see there are transaction effects associated with foreign exchange markets. Also, of course, some people called speculators might attempt to get a capital gains. They take a position that a currency is going to fall in the future, and they'll take a position to try and make a capital gain. It's a bit like gambling. They place a bet now, they buy a currency or they sell a currency now in the anticipation of making a capital gain, perhaps in a month's time or in 6 months' time. But this happens quite a lot, and it happens through what we call speculation. When we're trying to value a currency, we normally look at some key indicators. For example, in the country we're considering, we'd look at the index of consumer spending. Are consumers spending a lot or not? Is there high unemployment? What's the inflation rate? What's government borrowing like? Is the government borrowing too much? And all of these are indicators as to the value of the currency. If there's high unemployment and inflation is very high, the currency will not be attractive and not many people would want to hold it. So the value of the currency would fall. The government can also partly manipulate the exchange rate through changes in the rate of interest. I mentioned earlier there was hot money held by institutions and by fund managers and so on, and this money can move just about anywhere in the world. They're looking for the highest rate of return. Well, if the government in a country puts up the rate of interest, it may attract these funds. As the funds flow into the country, they have to be converted into the local currency, which will push up the price of the local currency. In other words, the exchange rate would rise. Of course, if another country increased its rate of interest, perhaps even higher, those funds would leave and they would sell the local currency, causing the local currency to fall in value. So it's really a short-term fix for changing the exchange rate. It can also lead to something called a beggar my neighbour policy in interest rates. We'll mention this again in a few moments. But essentially what that means is if one country offers, let's say, a return of 4% and money flows in and its exchange rate rises as a consequence, but if another country now offers 4.5%, the money may flow out and into another country. In order to get it back, the first one might have to increase its rate of interest to 5%, and so on and so on. It's a beggar by neighbour. They're trying to outbid each other to try and keep this money in their country. But of course, as the rate of interest rises, borrowing for investment purposes falls off. It's difficult to borrow money, and the whole economy suffers as a consequence. The central government influences currency by buying and selling its own currency. If the government wants to depress the exchange rate, let's say it wanted the exchange rate to fall, which would make imports more expensive, which would mean domestic industry would have to produce more and perhaps more employment as a consequence and better rate of economic growth and so on. So if it wanted to depress the exchange rate, it would sell its own currency on the foreign exchange market. It would sell its own currency and buy foreign exchange, which means it's building up reserves of foreign currencies and selling its own. But of course that would drive down its own exchange rate, and governments sometimes deliberately press down their exchange rate to encourage exports. China has done that for years, has kept its exchange rate down so that it could export a lot. The government could also have a low rate of interest. A low rate of interest means that centre, that financial centre, is not attractive for the hot money I mentioned earlier. It wouldn't flow in there, so it would be the exchange rate would be kept down. If the government wanted to increase the value of its currency, it could buy its own currency, perhaps using whatever foreign exchange reserves it's got. So it could go into the market, try to buy its own currency, thereby bidding up its price, bidding up the exchange rate. Or of course it could increase the rate of interest, thereby encouraging hot money to flow into the country. Now let's have a look at one interesting theorem related to all of this. This is known as the purchasing power parity theory, the PPP theory. Let's just look at a very simple example here. Let's take America and the UK. Now let's say prices in the UK are cheap, and let's say the same items in America are very expensive. That means America would import from the UK because they're getting it cheap. Consumers in America like cheap goods. Now that means that the exchange rate would fall because America's importing more than it's exporting. So the exchange rate would fall. That means imports become more expensive and exports become cheaper. So imports are becoming more expensive. That means to be less imports and there would be more exports. And the exchange rate would increase. It would cancel out the initial fall. That would continue to happen until the prices in both countries are equalized. So if you were living in the UK and you bought an item in the UK, you bought a particular product in the UK, you would pay this cheap price. If you went to America, you would have to change pounds sterling into US dollars. That exchange rate will give you so many dollars, and you could then buy the expensive price in America, and you'll find, having exchanged it, theoretically at least, you should have paid the same price in both countries. So the purchasing power parity theory is an attempt at balancing the price of goods through the exchange rate across different countries. In the end, the prices should be equalized through the exchange rate movements. Now, a floating exchange rate. Well, a floating exchange rate means that the value of the currency is determined solely by supply and demand of the currency. And the nice thing about the floating exchange rate is the government doesn't have to intervene to do anything. If we import a lot, the price of imports will rise. The exchange rate will fall and the price of imports will rise. That means we can't afford the imports, so it'll fix itself. If we export a lot and don't import a lot, the exchange rate will increase. That means imports become cheaper and exports become more expensive. It's fixing itself. So a floating exchange rate is attractive for that reason. The alternative to a floating exchange rate is, of course, the fixed exchange rate. This is where countries agree to bind their currencies together, and thereby hoping to encourage international trade by getting rid of uncertainty, getting rid of the uncertainty associated with exchange rate movements. One of the famous examples of a fixed exchange rate is the gold standard. It lasted up to about the 1930s, thereabouts. What this did was it fixed the price of gold to the currency in circulation. So let's say in the UK, sterling, the pound sterling, would be backed by gold, and the government could only issue notes and coins if it had the gold to back it. Now, if the country, if the UK, let's say, was importing more than it was exporting, that means it was paying for it in pound sterling, but in fact it was really paying for it in gold. So the amount of gold in the country would be reduced, making the country poorer. Now that meant there would be less imports into the country in the future. So the follow-up on this was that whenever exports exceeded imports, more gold flowed in than out, and the internal money supply rose, which led to pressure on prices, which led to exports becoming less competitive until the new equilibrium was found. The alternative to the gold standard was the Bretton Woods system, which came into existence in the early 1940s, just at the end of the Second World War. Bretton Woods is a small town in New Hampshire, and a lot of the world leaders met there to try and design a new fixed exchange rate system. The leading thinker at this time was the famous economist John Maynard Keynes. And Keynes and the people at Bretton Woods wanted to fix exchange rates to encourage world trade and redevelopment after the disasters of the Second World War. The Bretton Woods system itself lasted from the end of the Second World War to somewhere into the early 1970s. The gold standard system had collapsed. There wasn't enough gold around anyway to finance the volume of world trade. So what the leaders at Bretton Woods wanted to do was to try and get countries to agree to fix their currencies one against the other. In fact, what they did was they fixed the dollar at $35 an ounce for gold, and then all the other currencies were fixed to the dollar, thereby to gold, and were thereby also fixed one against the other. So all the currencies were fixed at Bretton Woods. They were not absolutely fixed. On a day-to-day basis, of course, trade would vary between countries, and it would be impossible to have it absolutely fixed. So there was a slight differential, typically around 1.25%. So it could rise by 1.25% or fall by 1.25%. In other words, currencies could move around 2.5% against what they agreed. If a country was running persistent imports greater than exports, then it would have to make some fundamental changes. It might have to reduce the income in the country, which would create unemployment. But that would mean that we were less, or the people in the country were less able to buy the imports. So a way of encouraging trade and prosperity was to create unemployment. It didn't seem right. There was a contradiction. However, the system was adopted, and it lasted for some time. If before countries could break their arrangement, they could go to the International Monetary Fund, the IMF, and borrow money. But of course the IMF was just like a bank, and it would impose conditions on the conditions of the loan, which countries would have to agree to. If they didn't agree to it, they wouldn't get the loan. It's like any bank. So if there was a major adjustment to be made on the balance of payments, then each country would have to adjust. It would have to change its fiscal policy or its monetary policy to try and solve the problem, which may inflict hardships on its people trying to maintain a fixed exchange rates. If it was totally out of line, if the exchange rate was certainly not working, then the IMF would give agreement to that country to change its exchange rate, and it would happen the markets would meet on a Monday morning to find a new exchange rate for some currency. It was done in absolute secrecy until the markets opened on a particular day to find a new currency. That happened with the pound sterling. In 1949 it was $4 to the pound. It was moved to $2.80 to the pound, and in 1967 it was changed to $2.40 to the pound. That's because no matter what the UK government did, the problem persisted. The only way to do it was to have a fundamental change. This is all of the issues associated with a fixed exchange rate. You will remember that a floating exchange rate doesn't have this problem. It just moves and up and down. If it falls, imports become more expensive, and it's for the consumer to decide if they want to buy them at a more expensive price or not. Back to the Bretton Woods system, eventually it collapsed, mostly because of a lack of liquidity and a lack of money in the system. In 1948 the world reserves of gold could finance about 48 weeks of exports, but only 14 weeks or thereabouts in the 1970s. So clearly world trade had grown, and the reserves necessary to fund that trade had not grown commensurate. So therefore there was an issue. There was also falling confidence in the dollar. The dollar itself in 1971 was changed in price against gold from $35 to $38 an ounce. So more people were looking a bit cynical at the dollar as well. So the Bretton Woods really, it fizzled out in the 1970s. There's also something called a managed exchange rate system. Managed exchange rate is floating, but the government intervenes. The government from time to time gets involved. The central banks get involved in the market to regulate the rate at which the currency is falling or it's increasing. So it's managed. If it's falling, it's still allowed to fall, but it's just managed downwards. It doesn't collapse. It just goes down in an orderly fashion. And within this there are two types. There's a dirty float, managed. The government at its discretion intervenes to change the exchange rate, and it does it whenever it wants. And whatever policy it's pursuing, it just gets involved in the foreign exchange market and changes the exchange rate. The other one is a joint floating. Sometimes countries get together to try and fix their currencies against each other. There was one famous one called the European Snake in 1972, in which countries in Europe tried to fix their currencies closely together, so that when one moved up, they all moved up. When one moved down, they all moved down. So that was the European Snake. That also collapsed, but the idea was to try and bring the currencies together. That was really one of the starting points for the modern euro. The euro is it's like an exchange rate that's absolutely fixed. It's 100% fixed. It's so fixed, it's one currency. That is the euro. But joint floating became popular as well, and it still happens. China, for example, very closely reflects what's happening with the American dollar, because it wants to have its exports to America. So if the American dollar moves down on the market, the RMB, the renminbi, or the yuan in China is moved down as well. The Chinese government will adjust it downwards. If the dollar rises, the Chinese government will adjust its currency as well. So it's floating very tightly, very closely to the American dollar. Then we have different political systems and economic systems that try to bring together all of this and try to make some sense out of the foreign exchange markets and get some sort of coherence and stability. An early one was the European monetary system, which lasted until 1993. This was a system where the idea was to develop a single market in Europe and eventually move to some sort of single currency. And there was a lot of systems tried out. The European exchange rate mechanism was tried out, and so on, to try and bring currencies very closely together. And of course, as they coordinated their policies closer together, eventually you could say, well, they're moving so closely together, it's ipso facto a single currency. And that's really the origin for the euro. The UK did not join until 1990, and then it got out shortly afterwards because of changes to the UK pound, problems with the UK pound on the foreign exchange market. So the UK has stayed outside of the European system and didn't join the euro when it was formed. In 1999, 11 of the then 15 European Union members joined the euro, and a new currency was born. And this currency has become stronger and stronger, and as more countries have joined the European Union, the currency has become bigger and bigger, and now it's one of the big global currencies, a big counterpoint to the American dollar. So this is some of the background to exchange rates, the European system, to policies related to exchange rates that went before the European system, and a general background to the financial side of trading, international trading. So we hope this was useful as a general discussion. Thank you for watching.